Hello and welcome to Wealthion's Weekly Market Recap. I'm your host, Andrew Brill. It was a quiet week news-wise with respect to the markets, but the market had a steady climb upwards. We'll take a look back at what all of our guests had to say this week, coming up right now. But first, please like, subscribe, and hit the notification button so you know when we post new videos. Before we get started, just a reminder that our next online conference is happening June 1st. You don't want to miss this. In conjunction with SALT, which is a 10-year-old conference started by Skybridge Capital, we'll have some of the top names and thinkers in economics and equities to help us all keep and grow our money. For information and discounted tickets to the conference, head over to Wealthion.com. This week, Peter Boockvar of Bleakly Financial and the Boock Report talked with us about the economic pressure points with high rates, housing challenges, business loans, and economic shifts in the U.S., and also gave us investment trends and projections he's seeing. So, Peter, we have a stubborn inflation number, the Fed obviously leaving rates for longer. What's your take on the economy as we sit right now?
I think that the economy is remarkably mixed and uneven. And I say that even with individual industries. Take housing, for example. We have the pace of existing home sales near 30-year lows, but new builds that are doing fine, filling up this supply vacuum. With consumer spending, we have lower to middle income consumers that are skimping on Starbucks coffees and McDonald's cheeseburgers, but we have the high end that is still spending and traveling and going on cruises and so on. You have manufacturing that's still in contraction, even though it's trying to find signs of a bottom, but we have all this government spending and government enticements to build manufacturing facilities and chip plants and so on. Global trade that is somewhat mixed with soft economies overseas in Europe, but then you have strength in India, weakness in China. So a tremendous amount of cross currents. So you can't really paint the U.S. economy with one brush. There's sort of this sort of two-lane economic highway that I'm seeing.
So we talk about, there's so much talk about recession, soft landing. What you're trying to explain to me is that there's different parts of the economy that could be in recession now, but certain parts that are kind of doing okay.
Yeah, that's what it seems. The person, as I said earlier, that's not going to Starbucks as much. They're sort of in their own personal recession, having to deal with a cumulative rise of 20% in their cost of living. Hopefully, at least offset as much as possible with wage growth, but it still stings. And I think consumers are really prioritizing on more needs than wants. But, as I said, higher income consumers are benefiting from a return on their savings of 5% if they're in treasuries and a wealth situation that is on firmer footing than a lower income consumer that is renting and doesn't own a home relative to somebody else that may own a home and has a locked-in 30-year mortgage at 3.5%.
Is that a switch from what you've seen in the not so distant past? Is that the discretionary spending was really, really high. Now we see, which what you're explaining is that the discretionary spending is kind of in certain income groups is waning, and in certain income groups is just continuing to grow.
Well, COVID certainly definitely polluted and pulled forward a lot of spending on discretionary stuff, particularly on goods. We know that was where the consumer spending strength was in late 2020, 2021. And then that flipped after everyone already bought their laptops and redid their kitchens and redid their deck and spent on stuff. Then they shifted to spending on going out for dinner and traveling and more experiential type stuff. That trend seems to still be in place, where experiential type consumer spending is doing better than hard goods stuff, particularly if it's an expensive hard goods stuff like a car, where you have to borrow money, and the cost of money to buy that car is obviously much higher than it was pre-2022.
especially for the government. Do you see the higher for longer? Is it working, Peter? It seems to be stuck in that just under three, just over three range. Do you see it starting to get down to where the Fed wants it?
Well, strangely, it's working in some areas, but it's also counterintuitively facilitating inflation on the other. On the higher end, because you're getting a lot of interest income, you're spending a lot, keeping prices elevated. Cruise lines, for example, to say them again, they have a lot of pricing power right now because of those boomers that are spending. So higher interest rates are actually inflationary if you're trying to buy tickets for a cruise or a sporting event, for example, or a concert. Uh, look at the housing industry. Home prices continue to go up in the face of higher interest rates. So in that case, because of the distortive nature of the Fed's policy going back 20 years with what they've done to the housing market, it's completely failed in reducing the inflation of home prices. On the flip side, cheap money drove an enormous amount of multifamily construction. So their attempt to create inflation actually sowed the seeds for eventual rental deflation. But now we're sowing the seeds for an eventual uptick in rental inflation in 2025, 2026 due to the dearth of new construction after the current projects are done. So it's hard to answer that question in one way because there's so many nuances in how rate cuts, rate increases flow through the economy. But I guess to simplify it, if you need to borrow money to build a business, if you need to borrow money to buy a house or a car, well, yeah, it's working. If you're in commercial real estate, higher interest rates are certainly working because we've seen certainly a collapse in the values of a lot of office buildings, and we're seeing stress in other areas of commercial real estate. So it's working in some areas and it's creating more inflation in others.
And since you mentioned commercial real estate, I'll ask you the question. I know there's a lot of commercial loans that are coming due this year. Those loans are going to have to be refinanced at a very much higher rate, probably double than what some of these people are paying. And the property
More than
values,
double, it'll be potentially triple.
and the property values, because of the higher rates, have come down. How is this going to affect the economy and the market?
Yeah, that's. I mean, just imagine every day somebody's loans coming due, and a lot of loans that came due in 2023 were pushed to 2024. So interestingly, going into this year, there was the assumption that there was about $600 to $700 billion of commercial real estate debt that would mature this year. Well, it turns out that number is closer to $1 trillion because a lot of 2023 maturities were pushed to 2024. So that industry needs a lot more equity. I think that's the bottom line. Either that or there's going to be a lot of wipeout of existing equity that will transfer to the lenders via foreclosure and handing back the keys. So there's going to continue to be a bunch of pain for those operators that have debt coming due. If you own a multifamily building that's 98% leased and your maturity is not to 2027, 2028, or you're all equity, then you're fine. If you're in industrial warehousing, maybe your rent growth is slowing, also multifamily, but if you have a good balance sheet, you're okay. It's really going to affect the piece of that $20 trillion market of commercial real estate where your balance sheet is offsides, which obviously definitely ensnares a lot of people. And we have to see how that sort of ripples into other parts of the economy. Also, higher for longer, when you think about its impact, we talk about how it impacts existing businesses, existing real estate owners. But we also have to think about what higher interest rates mean for future economic activity. What business doesn't get started because VC money is not coming their way? What house is not being bought and instead is rented because the cost, because interest rates are high on top of higher home prices for a millennial or Gen Zer who wants to buy? What business is not expanding because they don't feel like taking out a 10% loan from the bank? It's what activity does not take place because of higher interest rates in a very credit dependent economy.
And that'll take a little bit of time to figure out, right? If what isn't being done.
Right. That's why this is not sort of an easy, quick, you have the digestion of higher rates and then you move on. This is something that plays out over many years because of the amount of debt that was priced pre 2022 that over the coming years will get repriced much higher. And if rates stay higher for a while, there's obviously sort of this pernicious death by a thousand cuts impact that I've been thinking is going to happen for a while now, and it sort of seems to me to be playing out in that fashion.
So the amount of debt that people take on, our government has taken on a ton of debt, and to finance that debt, we're selling bonds like it's going out of style. Peter, how is this affecting our economy? Because now the government's borrowing money, they're paying more to borrow that money. Our debt continues to rise. The bubble's got to burst at some point, don't you think?
Well, it's for 40 years we've been talking about wide U.S. budget deficits, outside of a couple of years, and it never mattered. But to your question is, does it now matter? And I do think it does matter. I mean, in the 30 years I've been doing this, I never paid attention to the Treasury's quarterly refunding announcement, or never really paid attention to Treasury auctions until the last couple of years. So now that we're talking about this and paying attention to it, it really is important. And when you have an expanding economy with an unemployment rate below 4% and a budget deficit relative to GDP at 6%, that's highly stimulative. So there's basically $2 trillion more being spent relative to the income the government is collecting that's flowing through all parts of the economy. So here you have the Fed tightening, but fiscal policy continuing to ease. And the question is can the U.S. Treasury continue to finance all this? And I do think it's getting more tougher around the edges. Now, the Fed has relieved some of that via trimming their QT from 60 billion a month in treasuries down to 25. So Janet Yellen got some relief, and not a coincidence that it's shortly before the election. But foreigners have also been a large contributor to financing the U.S. debt, and their percentage ownership of marketable securities, while they're still buying on an absolute basis, that percentage continues to drop. So more and more supply, wondering where the buyers come, could sort of flow in and give reason why, at least the long end of the yield curve, rates are going to stay high for a while as well, in addition to what the Fed does with the short end.
Do we expect to see prices come down a little bit now that the wages aren't coming down, but they're stabilizing somewhat? Do we expect the prices to come down a little bit at some point?
No, prices will never come down. Maybe they'll just go up less, unfortunately, for those that have suffered through a very sharp rise in their cost of living. When it comes to wages, just for perspective, in the 20 years leading into COVID, average hourly earnings were averaged about 2.5% year over year. So now they've moderated, but they're still running at about 4. So that's off the boil of north of 5, but still running well above where it was pre-COVID. Now, for the wage earner, that's a good thing because of higher inflation. But it definitely, from the Fed's perspective, certainly makes their job more difficult. And California, as I said, their minimum wage increase certainly doesn't make the Fed's job easier either if all of that wage increase gets passed through to higher prices, which it seems to have been. There's only so much productivity a restaurant can instill in its business.
How do we make money in today's economy and with everything that's going in the market?
So we remain, I mentioned precious metals, but we're long and bullish on a bunch of different parts of the commodity landscape. Energy, agriculture, particularly fertilizer stocks, also bullish on some of the industrial metals like copper and some of the stocks in that industry. I still think that there's been just a dramatic pace of underinvestment in commodities over the past decade as everyone shifted to spending on technology and other things. If you're a VC, investing in that new copper mine was not that sexy. Other things was more attractive. So I do think that prices on the commodity space are going to be high for a while and will go higher. And I still think that there are a lot of areas of commodity stocks that are cheap, particularly agriculture. That's one of our newer positions over the last couple of months is buying some of the fertilizer stocks, and that I think that have a bunch of upside. And also, we also invest very internationally, and I still find markets in Asia very attractive, particularly in Hong Kong, which has been a dramatic underperformer up until recently, where one of my contrarian calls going into this year was the Hang Seng was going to outperform the S&P, and after a pretty brutal start to that call with the Hang Seng down 10% in January, it's finally done a lot of catch up. So I think there are opportunities in Asia to play the growing middle class there.
So that's how to make money. How do we protect ourselves from the volatility, some of the volatility that we've seen? Someone who's maybe on a little bit more of a fixed income?
Well, you can never really protect yourself completely if you want to be invested in the markets. The only way you're fully protected is if you're in a treasury money market. But I think people just have to learn to live with the volatility. And I think extending out one's time horizon is the best way to deal with short-term volatility. Because if you know you have that long-term time horizon, you can deal with a lot of the short-term noise.
Dylan Smith of Rosenberg Research spoke to us about earnings trends this week and what he's seeing in terms of an economic slowdown. He also touched on what lies ahead for consumers and businesses, the rising debt, and the impact this year's election could have on the economy. So we're towards the tail end of earnings season. There's a bunch of companies, the big ones, that have come out with, they have piles of cash, and they're either giving dividends or they're going to spend on AI. But there's a bunch of companies that are not doing as well. Do you see the economy slowing at all?
Well, I think what you're seeing in this earnings season, somewhat a continuation of the trend around tech and AI, which I think was always going to be the case. We've seen a mix of signaling on that, which I think is starting to reflect the realities of the situation, which is that certain firms are doing extremely well and reporting, actual revenues coming through AI. That's more on the sort of hardware side of the industry with NVIDIA and the likes of those types of companies actually benefiting from it. You've also got places like Meta saying, look, it's going to take longer for this to actually show up in the income statement than you might like, or at least in the top line of the income statement than you might like. But, we're putting a lot of money into it and we're hoping to see a lot out of it. And investors, by and large, liking those types of stories. So we haven't seen the kind of come to Jesus moment yet on where the real winners and losers will be kind of long term. I think that's still a very open question. But what we're seeing from the kind of old economy side of the book is really a fairly traditional trading down consumer. So the signal we're getting there is, places like McDonald's signaling, listen, we're about to enter an actual price war. We're going to adjust menu items. We're seeing people price discriminating even on our own menu towards cheaper items. We've got, some of the retailers doing quite well, although the more sort of high-end total consumer linked retailers like Amazon showing, slightly softer results on the retail side of the business. And then of course the Starbucks debacle, which, China aside is showing a slowdown generally in global demand. I mean, there's all sorts of issues in that business, which, we're not really positioned to comment on. But what you are seeing, I think, is people moving down from the very fancy Starbucks latte down to just a black coffee and get on with their day, right? I think there is some trading down happening. And what that means for the consumer is really, okay, we know where the kind of bottom end of the market is, the people who kind of spend their whole paycheck. The side of the economy that is contributing to the savings rate really collapsing and high credit card spending, like that's all a consistent story. I think the outlook on consumption is really going to depend on, okay, what's the upper echelon of the income spectrum doing this? Because those are the people who have seen enormous gains from their house price and their ability to withdraw equity there, and they're seeing a massive wealth effect from recent stock price moves. And so even though, I think most of the economy is out of the kind of pandemic era excess savings that's been spent down, there's been an additional tailwind for kind of the upper end of the income distribution from all the markets. So interesting to kind of see what we can tell about the consumer for those different forces at play.
So one question I have about that, since the lower end of the income distribution is, I'd say readjusting, so to speak, whereas the higher end of the income distribution doesn't have to worry about that as much. But Dylan, we're still paying very high prices for food and essential items. When do we get relief from this stuff?
Well, if you're asking when are we going to get outright deflation, it's not going to happen, right? We know that firms are very, very unwilling to actually reduce prices to end consumers. What we are seeing is that relative prices are kind of readjusting. So there's a few moving parts at play. One is we had this massive initial spike in goods prices inflation, right, and that was because of how demand had shifted off services onto goods after COVID. We then saw it kind of bleed into more of the services side of the economy as things readjusted, and that was sort of where the shortages were relative to demand. And we put out a piece a few months ago, which basically showed, these two things have actually equalized back to the pre-COVID norm. So not really a relative prices story, but I think when you hear in the media about, things are expensive, consumers aren't lying. The average sort of grocery bag has almost doubled from pre-COVID levels. So although inflation is running low right now, I think the sort of challenge that policymakers and economists face is to explain that this readjustment is not going to happen back down again. This is a fundamental kind of change in sticker prices, and the big question, I think, is how do incomes readjust to that? So we've seen in many sectors there has been real income catch-up and real income adjustment, but not in all sectors. And I think that's what's part of the story, behind things like how many part-time jobs are currently being taken, people who, can't adjust from one job to the other without driving an Uber in between, just to make ends meet. So I think that's a big part of the story, and why demand is a little dampened on that side of the economy is the sort of budget shock is still kind of happening. And this is interestingly happening at the same time that you have still, package holidays demand very high. So there's still an element of, while we're sort of angry about grocery prices, we're still going to go to Disneyland because we couldn't do it 3 weeks. So there's very interesting kind of cross currents happening there. But I think the broader pattern which we're seeing, back to the earnings release question, is that I think that force is fading and reality is setting in.
And the latest wage report is that wages are up, but they're not up as much as they had been. Like the wage growth is slowing. So if prices don't come down and wage growth is slowing, at some point there's going to be, I wouldn't call it a price war, but perhaps prices could start to come down if people can't afford what staples they need.
Right. So we're seeing inflation, depending on the measure, there's lots out there, but running somewhere in the order of sort of 4%, and you have inflation running just over 3%. So we're still seeing a little bit of real income catch-up happening, but it's at a much slower pace than it has been for a while as wages moderate down. But you're absolutely right on sort of businesses' ability to pass through costs at the moment. We're seeing in the Beige Book and in all sorts of regional Fed data and reports, everything is pointing to margin compression, at least for the sort of small and medium-sized firms in the economy. Larger firms, it kind of depends where they're playing. But firms have lost the pricing power that they've enjoyed for 2.5 years. And yes, there are definitely sections of the economy where that will mean that prices do actively come down. On average, we're not looking for a base case of deflation, but getting to 2% against that background is not going to be that difficult.
So getting down to the 2%, but we could hurt a little bit and struggle until we get there because prices aren't going to really come down, and unemployment is sort of creeping in the upper direction. So there's going to be people out of work that can't actually pay for what they need. So I would assume, and correct me if I'm wrong, at some point things have to level off.
I think that's right. And I think that's why Powell has explicitly said he doesn't have to see 2% to cut, right? I think, and that's why he flagged the labor market as, one of the potential scenarios that actually could lead them to cut, kind of inflation aside. Yeah, I think that's right.
When you tell people that we need to pay down the debt and we're going to tax you a little bit more, that's not going to be an easy way to win an election, I would assume.
yeah, we're going to change Social Security. No one can say that. So this is off the table until the election for sure. And after that, we'll have to see. Now, based on current record, the Biden administration has been a very free spending administration, partly related to kind of COVID recovery and so on, but also following the kind of COVID spending was a very large infrastructure investment program. You can argue and debate about the long-term kind of ramifications of that, whether it's going to be efficient public spending, whether it'll be a big economic return. But until the evidence there shows up, all we know is that has sustained very high deficit spending. And then the kind of wave after that has been just that current spending has been a lot higher than anyone expected. We saw, if you assume a relatively small multiplier, you still find that last year, direct and indirect effects of public spending accounted for like 2/3 of GDP growth, right? So it's been an enormous additional extra stimulus that almost, everyone was predicting a recession. It was almost like they did a preemptive Keynesian policy, right, by just massively stimulating or keeping stimulus going. But the point I'm trying to make here is that, if Biden kind of remains in power and it's a Biden-led administration, well, he doesn't have a track record of fiscal prudence. Now, that's not to say he can't change his mind, but he's certainly not campaigning on changing his mind. And in focus groups and polls, this is, public debt is not coming up as a key issue. There is no part of the electorate or no sizable part of the electorate that, you're going to win over with this. That's not 1991. And meanwhile, we know that Donald Trump kind of appeared to assess his efficacy by the state of the S&P 500. And the easiest way to keep that up is to kind of, just not tax cuts probably, and which we know, large sections of the Republican Congress are quite keen for. But as we saw last time, probably not too willing to offset that on the spending side. So you actually get additional fiscal stimulus probably in that scenario too. So it's very hard to see a path to a real big reimagining of prudence without something going a bit wrong first and bond markets basically throwing a tantrum and forcing them into it.
On Next Week on the Trading Floor, Jon Najarian shared with us his thoughts on the Fed keeping rates unchanged and gave us 3 new stocks to look out for, one he's recommending, one he's not, and the unusual options activities for the week. All right, so it's time now to get to next week. We do call it Next Week on the Trading Floor for a reason, and we're going to pick a winner for next week, and with that, you're going to mess with my cup of coffee, and I'm okay with that.
Yeah, and we both wish that cup of coffee wasn't so expensive. And I think the Starbucks CEO is going to be loath to go back on with Jim Cramer on his Mad Money show because Jimmy tore into him. This isn't Howard Schultz, of course. This is the guy that came into basically that Howard handed the baton off to on his second time leaving the company. And he gave it to this guy, and Jim was just all over him. So I always thought that it would be good, Andrew, to sell an addictive substance like caffeine, like nicotine, if we're talking about cigarettes. And because people keep coming back for it, they can't quit it. You and I probably can't quit it, but we can move to a different delivery mechanism for that. So we could go to Tim Horton, we could go to Dunkin' Donuts, we could go to McDonald's, you can go to so many places where you're paying less than half of what they charge you at Starbucks. So it hit a new 52-week low around $72. For that reason, I think it's a buy because I still believe in Starbucks and how much people love the customized drinks that they make. Because of course, if you're talking about Dunkin' or any of those others, you're really just talking about black coffee, dark roast usually, and you're not getting all the specialty stuff with it. I think at $72 a share, it probably represents a nice bounce area at that 52-week low. And by the way, that's right around the 50-day moving average. So again, I like Starbucks going into this next couple of weeks.
Not only that, they're moving into a new market much, much bigger than they had. They're getting to China now. And China, from what I was reading, has a ton of coffee shops, coffee distributors, that sort of thing. So they're now getting into China, and they expect to expand rapidly into China, like they did here in the United States. So we'll see if they can expand and grab some of the market share over in China.
True. Yep. And I think they can. So I think SBUX is a buy at around this $72 level. Like I say, a new 52-week high this week. 52-week low. I misspoke, this week.
All right, John, so you've got me all caffeinated with Starbucks coffee. Now let's head on over to our loser of the week. And we talked about the airline industry last week. And for the loser of the week, we're going to head into the airline industry once again.
This one is Spirit Aerosystems, SPR. And Spirit makes like those doors that fell off the Boeing aircraft. They make those doors. Unfortunately, they were improperly drilled, apparently, and Spirit has suffered for that, SPR. I think it's a good company, but when you have a whistleblower like this guy, Joshua Dean, Boeing already had its own whistleblower against some of the procedures to check out the aircraft and so forth at Boeing. In this case, Joshua Dean was over at Spirit Aerosystems and Boeing because Spirit was supplying these, and he became a whistleblower. And then suddenly, just like the whistleblower at Boeing, he died suddenly. And, we're not saying that Boeing or Spirit did anything untoward. They said that he died of a bacterial infection, but my gosh, if you're looking for some downside, I think SPR, there's somebody bought 20,000 put options in there. So that's a pretty big bet that by the third week in May, we're just finishing the first week in May. By the third week in May, this stock trades lower and they're right at the money, right at $33 a share. So a put option is, of course, the right to sell, folks. And for somebody to buy 2 million share equivalent to sell in Spirit Aerosystems tells me everything I need to know. I'm short Spirit Aerosystems.
So let's go to your options. This is your bread and butter. This is what you really look at, and the unusual options activity. So where are you seeing some unusual option activity this week?
Well, when I talk about AI with you, Andrew, or with Steve Feldman or whomever over at Wealthion, when I talk about AI, we're of course talking about artificial intelligence and which are the stocks that benefit, which are the picks and shovels. So just like Levi's was one of the biggest winners in the picks and shovels and pants necessary for the 1849 gold rush in California, this one, Palantir, is necessary, I think, for artificial intelligence because these guys, strong fundamentals, they basically use all that data that you get, the data that artificial intelligence needs to process. This is one of the players that does that. So we could go to Micron Tech for memory. We could go to NVIDIA for memory and chips and GPUs. We could go to Super Microcomputers, SCMI, for the rack systems that are necessary. We can go to so many different places for AI. But in terms of analyzing it and taking that data and turning it into tradable or investable ideas, I think Palantir is right up at the top of that food chain. So I'd say 20% off their recent highs, mostly on light volume to the downside. They're buying 10,500 of the May 35 calls. So what does that mean? A 35 call gives you the right to take stock at $35 a share, no matter how high it goes. So a call option gives you the right, but not the obligation to take stock at a certain level for a certain time frame. So I've already told you the time frame, May, and so the third week in May, in fact, and the price level, 35. Well, the stock was $22 a share when they were buying that. That's too far out of the money for me, folks. So what I do is I pick something closer to where the stock is trading right now. So if you're a stock trader, of course, you just buy the stock. If you're an options trader like me, you buy an option at that 22 strike or at the 23 strike or maybe even the 25s. 35 is too high for me. I'm not really thinking that the stock could jump by $13 in the next 2 weeks, but I do think it could jump, and I will reflect that belief by buying an at-the-money call. And I think that's going to be a smarter way to play the upside of Palantir.
And I think if last quarter they had, when they came out with earnings, they talked about getting a government contract to supply AI for some military stuff. So they should be on the up and up right now, trading in just above $23. So whoever was buying those calls, they're in the money already. So unless if they're going to buy at 35, that stock is definitely moving in the right direction. It's actually a stock that I watched after the earnings came out last quarter, and the stock popped and then it started to drop down a little bit. I'm hoping you're absolutely correct that one's going to start going up. And with AI being all the talk again this earnings season, Wealthion welcomed AI expert Saul Rashidi, who explained how AI could shape the future of financial advising, resource exploration, and the concept of balancing productivity with employment.
And if you look out 5 years from now or 10 years from now, would a traditional financial advisor or stockbroker, as they used to be called, do you think that job just disappears? Because a big part of their job right now is just gathering assets, right? And then I think they take an individual's information, they throw it into a computer, and they say, okay, this is where we're going to allocate resources. Do you think that's gone like in 5 or 10 years from now? And we have these like robo-advisors doing everything?
I think that's the path that we're going. The role will definitely evolve because at some point in time, the customer is going to say, why am I paying you a percentage point when you're giving me the same answers as ChatGPT or Gemini or Perplexity? Or because I was Series 7 certified for 17 years. I traded options. But I started out as a financial advisor before I became a broker. And as a financial advisor, you don't get really creative. If fundamentally they're 60 and above, they're close to retirement, they're low risk exposure, it's all about passive income coming in, you're going to invest in bonds, but you're not doing these like high risk growth based investments. You're just not. That's meant for a younger constituency group. And then based on their income level and what they can save, that's where you play with numbers. Well, this was in the early 2000s when I was doing this. You fast forward, that formula has not changed. How you treat a 21-year-old that's in their growth period and part of their wealth accumulation phase versus how you treat someone who's over 65. And let's say, assume they don't have a family office, so they're not making the investments. At this point in time, it's just to be able to retire comfortably. The formula has not changed. It hasn't been too creative. So why do I need to pay a percentage point to someone to tell me what I need to do when all I have to do is type the question in and it's going to tell me what to do? In addition to that, whether you're investing in American funds or Fidelity, or it doesn't matter which fund group, they're all looking at embedded AI because they want the business to come directly to them, which now means if you're going to invest with a fund, they're building these capabilities on the website where you tell them a little about yourself and they're going to ask you anywhere from 6 to 10 questions. And then they're going to suggest what the right investment mix is for you. So I would say at some point in time, we're going to wake up and ask the question of why do I need to pay you to do these when I have these capabilities available to me?
And they're performing better.
And that's a bit of a provocative area to step into. I'm sure people can debate that. But to be honest with you, yes, I have seen that. It's almost like you used to have to pay for email, and then now everyone has email and it's for free. It's a democratized service. So I think that the way AI is going to disrupt things is not replace jobs, but it's going to force the evolution of certain jobs. And things that we used to pay for are now going to be available for free at our convenience when we need it, when we want it.
Interesting. So I do a lot of work with resource companies, oil and gas, base metals, precious metals, et cetera. And this can be a very laborious process, looking for oil, looking for minerals. And it's also very costly. And especially when it comes to oil, like if you have an offshore oil rig, depending on many variables, how deep the well is, et cetera, it can be very expensive. Like an offshore rig can cost you anywhere from $250,000 a day up to $500,000 a day. Mining is a lot cheaper, but nonetheless, it's still a very laborious process. With mining, you're flying around in a helicopter, you're trying to identify certain minerals, on the ground, and then you pick out these targets and then you start drilling. But it's not really efficient. How do you think AI will be utilized when it comes to resources and the exploration of resources?
This is going to sound so odd, but I love this space and that vertical and industry for two reasons. Because there's an AI hat that I have, and then there's a data hat that I have. On the AI hat, like there are just 5 glaring use cases that a lot of the mining companies or mineral extraction companies are starting to play around with, and some have actually been deployed. The easiest one is around predictive maintenance on the equipment, right? So predicting failures before they actually occur in order to reduce and minimize the downtime, which if equipment is downtime, it impacts top line revenues, right? That's just the life of it. But also being able to measure shelf lives and being able to predict when repairs need to be made in order to avoid productivity loss. Then another application that I recently read and I researched, and I thought this was amazing. It's not in production yet, but they're actually exploring it, is around ore grade prediction. So predicting the grade of an ore that's being extracted by analyzing the geological data from different drill samples. This is giving companies the ability to increase the accuracy of their grade predictions, and they're seeing a yield of anywhere from 10 to about 18%. Now, this hasn't been deployed at scale yet, but with the proof of concepts that are out there, they're starting to see an average of about a 15% uptick in accuracy. I think another area is really around environmental monitoring and compliance. So being able to see potential compliance issues in real time, and making sure that you reduce environmental incidences with, it could be employees or regulatory standards that have been set forth. There's applications that are already live in scale and prediction around autonomous drilling. So autonomous drilling rigs, and just like Tesla is investing in autonomous vehicle, having autonomous trucks equipped with AI operations so that they could reduce the labor load and increase the safety of these drills and vehicles, but more importantly, also reduce fuel consumption, which is interesting. I wasn't aware that fuel consumption is one of the primary costs for ore extractions, which I thought was interesting. And then the last one is really around resource exploration. So leveraging AI algorithms and models to analyze geological data, to be able to identify new mining sites. And they're able to do this by taking a scan of the geological terrain and understanding the composition just based on a variety of different infrared technology. So this space in particular, there's a lot of exploration. I would say most of it is exploration. Very few things are in production and at scale, but it's definitely seeing a lot of momentum. That's on the AI side. And then on the data side, there is a fundamental challenge that companies that operate on edge have that I don't think people are exploring. And this is something that, there's a company that I'm partnering with, Armada.ai. And what's interesting about them is telco, logistics, oil and gas, mining, these massive corporations and companies and enterprises that are the backbone, quite frankly, of our economy. They don't operate necessarily in centralized cities where Wi-Fi and connectivity is just readily available. They're operating in remote areas because they're doing, mineral extraction in these mines. And so they fundamentally have two challenges. One is connectivity. So even if you were to leverage AI, or even if you were to deploy sensors across a variety of equipments to be able to do prediction monitoring, connectivity is a challenge. So how do you partner up with the Starlinks of the world to be able to enable Wi-Fi connectivity? So even if the data is coming in, how do you process it? And how do you understand if an equipment's about to fail or not? And then the second is around data processing. Because even if you have connectivity, it's not like you have a server sitting out in the middle of the desert or in the middle of the mines, everything is being leveraged through cloud, but you cannot transmit that amount of data over the cloud without these heavy, heavy workload costs. So unless you're willing to spend several millions, right, in a week, just being able to do data transfer, it's nearly impossible to extract the insights from these sensors and these AI applications out on edge. So the technology and the solution that we're working on is, how do you process information on edge and then bifurcate the essential data from the non-essential data, and then send only what's relevant, the essential data, through the cloud-based workloads into corporate or into enterprise. And so people aren't thinking about this stuff, but it's not just let's deploy AI. It's, you've got to think about, well, I need connectivity. I need to process the information. How am I going to actually transition the information so it could be analyzed? And so these are all the things that we're working on behind the scenes to be able to make these AI applications scale.
Finally, on Speak Up, Staci Warden, the CEO of the Algorand Foundation, spoke about blockchain's impact on transaction costs and security. She also compared different cryptocurrencies, gave insight into Algorand's unique propositions, and also shared ways she thinks crypto is going.
The idea that you could understand the origin of transactions and understand the destination of transactions, all of these things are enabled by a blockchain. And, the one sentence on it for me is that I think it's crazy that you can send from, if you're in Nigeria, you can send somebody in Malaysia a movie over WhatsApp, and that movie will get there in 1 minute. But if you try to send them $10, it's going to get there maybe 10 days later. A bunch of different intermediaries along the way will have taken, up to 5 or 6% off the top. Why can't you send money immediately from one person to the other? The way that you do that is if all parties are participating on one ledger of transactions and everybody can see what's going on. So for me, this idea of shared knowledge, one ledger that the blockchain delivers, is really just an absolute game changer. And I want to be a part of rolling that out globally.
Okay, so I'm going to throw some things at you. I want you to react.
Okay.
Someday on my phone, this smartphone that's distracting everybody, I'm going to have my money. It's going to be right there on my phone. And I'm going to be able to not use a credit card. I'm going to be able to go right to you, peer to peer. And I'm going to be able to buy a coffee, shop in a supermarket. I'm going to be able to do things that we're typically doing now that have frictional costs to them. Right. If I go to the supermarket and I pay with my credit card, there's a 3% charge to the credit card company. It's sort of an amazing thing. The credit card company has a 3% partnership with every vendor in America. Yeah. There's trillions of dollars that go through the world of finance. Yeah. I tabulated this the other night. I was in a debate where some people don't like blockchain. Other people do like the blockchain. But I pointed out to people there are $4 trillion of costs associated with verifying transactions in our society. $4 trillion. So what you just said, if I heard you correctly, is we now have the technology to bypass those costs. It's the same way we now can make a long distance phone call over the internet, which is virtually costless. When we were growing up as kids, maybe it cost us $3-4 a minute to make that call. Right. We can do all of this now seamlessly. We can be protected by the verification mechanisms of the blockchain. What am I missing?
Yeah, I mean, I remember being, on the Eurorail, like a student backpacking in Europe, and always hoping that my mother would answer when I called collect instead of my father, because he, the cost was so high. He'd be like, "Okay, honey, I hope you're doing well. Let's hang up." Whereas my mother would keep talking to me, But I think you can get super duper futuristic on this. For example, why are we talking about assets and money as different things at all? If everything is digital and you have, say, an Aberdeen money market fund, you could have this tiniest sliver of that fund tokenized, say, for example, on the Algorand blockchain. You could pay for a cup of coffee with the tiniest little piece of that fund, right? And you could do that directly without intermediaries. And this idea that your money is always earning income, that your bond coupon could be earning money for every hour that you hold it, not have to do this complicated bond math from coupon to coupon payment, right? It becomes very, very continuous as opposed to a very discrete financial system. There's a rental income protocol built on Algorand called Lofty, and you can buy tiny pieces of rental property for $50 investment. That's already cool enough because that's a kind of investment that normal households don't have access to. But as a rental property owner, you are paid daily on your property, not monthly, because finance is becoming more and more continuous. As opposed to, remember when we all cheered when we went from T+3 to T+2 in traditional finance? It took like 2 years to get that done. This is all, the thing about crypto is that clearing is settlement. There's no difference between it. So back to your cell phone example is you can get this done immediately. You can make a payment immediately. You can make it with sub-penny transaction costs. But there's an onus on you to make sure that you don't lose your password for your money. These intermediaries do serve a very important purpose. So there's a lot more responsibility involved right now in crypto. And I think one of the problems is that we've got to make it more user-friendly and kind of meet traditional investors in the middle with how well we take care of them versus how much we can save costs by getting rid of some of these intermediaries.
Okay, so we're both, I'll stipulate this. I'm sure you agree. We're both bullish on the sector. We're both bullish on the idea that the blockchain and layer one technologies like Algorand will be used to tokenize real world assets. Yeah. I personally just invested in a self-portrait that Basquiat made of himself and Andrew Warhol. The portrait was sold for $32 million at auction a few years ago. The gentleman that purchased the piece of art is a friend of mine. He sold 20% of the painting to a group of his friends, and he tokenized it. And so I bought the token. It's sitting in my wallet. It represents this painting. And so that's happening. It's going to happen in real estate. It's going to happen in other real world assets. I want you to paint a picture for me of where we are in 2029. It's 5 years from now. It was well timed, the horn outside blaring. 5 years from now, where are we? What's tokenized? What isn't? What is Algorand's role in all of this 5 years from today? And as you and I both know, the 5 years comes up very quickly.
Yeah, 5 years comes up quickly. But I think we are in very early innings for crypto more broadly. So I'll start with crypto more broadly. And then the answer for Algorand is, of course, total world domination of crypto. I expect that to be happening in 5 years. But crypto is going to continue to make inroads into traditional finance. And traditional finance, I think, is going to continue to avail itself of the good things about crypto. Ethereum, for example, it's very, very decentralized, but it doesn't scale very well. The transaction costs are very high. They're called gas fees, and they're very high. If you look at another protocol like Solana, for example, it's a very fast protocol, but it's not particularly decentralized. You have to run enterprise-grade hardware to participate in that network. With Algorand, you can participate in the security of that network with a laptop, a performant laptop, but you also have a lot of scale and speed to it. And we are quantum secure. That comes from having some brainiac cryptographers working with Algorand. So the history of transactions on Algorand is quantum secure, meaning you cannot go back in time and say, oh, Staci didn't really pay Anthony. Actually, Anthony paid Staci, and change that. And so that I can kind of double spend the same amount of the same dollar that I have. So we solved what is called what Vitalik Buterin's very famous trilemma. So we were able to get decentralization and at the same time speed and scalability, and at the same time security. So thank you for teaming me up to talk about that. But that's our core value proposition.
If someone's going to tune into this show, a lot of people are not where you and I are. I had the eureka moment 5 years ago. Knew I had to be in this part of the world from an investment point of view, needed to understand it better. Some people are going to tune into this show. I want a part of it. What makes this show successful is here's a portal. Here's a look into the future. and you've described it eloquently. Talk about the roadmap ahead, the consensus incentives coming up. I had the chance to be with your CTO serendipitously this morning, and he was talking about some of the things that are coming up in terms of tokenomics for Algorand and some of the things you guys are working on. Tell us about that.
Okay, well, as I said, we were founded by an academic, and our academic is very, let's call him pure of heart. And he recognized that you only need a laptop to help run this protocol. And so he said, you as a good citizen, if you avail yourselves of this ecosystem, you as a good citizen should help keep up the security of the network. Every other blockchain, though, pays you to do this, to keep up the security of the network by staking your currency of choice or by mining in the case of Bitcoin. So we have decided to move to a form where you're going to be compensated for putting your algos to work to secure this network. Now, the difference, and we call this a pure proof of stake, because unlike other networks, you maintain ownership of your algos. You're not locking them up anywhere. You can continue to use them. But if they're staked now, for the first time, you will be able to earn money for performing that service. That is very easy for me to say, but that is a very big engineering project. And we have been working on that for, a good part of a year. And when I say we, I mean the brainiacs over at Algorand Technologies in Boston. But they are building that out, and we expect to go live with that this fall. So if you want to participate and you will be able to do this easily. It's not that you have to go and get a mainframe computer or any of that other nonsense. You can do this easily, and you will be able to earn money for the work that you do securing this network. So it's pretty exciting because the energy footprint of this network is about that is required to charge a Tesla for a year. It's a very lightweight. It's a very lightweight network, but you do have to stake your algos to make sure that we're decentralized enough, because that's a part of where our security comes from. So we're going to pay you to do that. And I know you're going to do that, Anthony. So
I love money. So of course I'm going to be doing that. You have a new CMO. I also had the opportunity to meet him this morning.
Okay.
Your new CMO told me that for the last 10 prior years, he worked at Google to build out something called Android, which is
right.
the largest software package operating system for cellular phones in the world. So it's not just Samsung, it's Motorola, it's everything other than Apple is coming through Android.
Yeah.
How did you snare him? Tell me, I need recruiting techniques from Staci Warden of the Algorand Foundation. So give me the pitch. How did you snag him?
Yeah, I'm sure some members of the Algorand community are also going to be listening in. We have had some marketing stalling on Algorand for some time, and we had a good CMO before, but not quite a good Web3 CMO, I will say. Very talented, but not right for us. And so I could not make a mistake with our CMO again. The community has no tolerance for this at all. So I really needed to make sure that I got a perfect CMO. And when you think about Android, and he told me when I first had the opportunity to speak with him that he had a budget of $30,000 when he started, and there was no Android on one phone, and he had to build this thing up from scratch for Google. And it occurred to me that Android's an operating system in the same way that Algorand is an operating system. All of these kind of headwinds, I was very struck there by the fact that people are still bullish on the United States, and the United States is the place to
the S&P, buy the S&P.
Look, I always say, if my friends come to me and ask me for investment advice, I say, first, leave it to the professionals, and second, be diversified. And so I think if you don't have a lot of time and a lot of expertise, you're definitely better off buying a broad index. This is why these Bitcoin ETFs are so exciting, by the way, because, there's let's call it $4 trillion odd in retirement income. And people of our age, Anthony, we typically use registered investment advisors. And RIAs, they typically buy ETFs, right?
Mm-hmm.
And so the idea that, wealth advisors like you guys, you are, of course, the professionals that people should leave these decisions to, but also you have an opportunity now to have an entirely new asset class in a product that your users are that your customers are comfortable understanding. And so if you take those trillions of dollars in assets under management that advisors like Wealthion have, and you just imagine, this is not financial advice, but you just imagine 1%, 2%, 3% in a Bitcoin ETF, for example, then that's, to me, a very interesting way to diversify. And it's a bullish, of course, signal for the sector as a whole. And the cryptocurrency sector as a whole does tend to follow Bitcoin's lead. I think that was a bit garbled, but I hope I got my point across.
Listen, I think it's important because you're tapping into the consensus of a lot of very smart people. And of course, for those listening in, you can go to Wealthion.com and you can yourself plug into our group of RIAs, Wealthion advisors, if you will, for free consultation. So just have to go to Wealthion.com. Before I let you go, we take questions from the audience.
Okay.
So we're going to fire up some questions. And
all the hard questions go to Anthony. All the easy questions should come to me.
All right. Well, I'm going to read them, and then you tell me the ones you want to take. Okay, you ready?
Okay. All right.
The economy on paper seems to be going in the right direction. However, I want to be prepared. What are the top things you suggest to protect myself from an economic collapse? This is Johnson from New Hampshire.
Okay, I think if you are a global investor, I think the problem always is that when the neighborhood starts going, the iffier neighborhoods go first. And so you want to be in the center of town, as it were. So I do think if the economy globally starts to get in some trouble, I think you want to bring back to the US. I think you want to make sure you are in a well-capitalized, too big to fail bank. I think you should make sure you probably stay under the FDIC 250,000 limit in each bank. I like property for diversification, and I think you should consider some small allocation to digital assets as well.
All right, so it's good. It's a great answer. I think the biggest thing, Johnson, is stay diversified, but stay optimistic. I think what ends up happening is we get very nervous when economies are shaking or there's a recession or a financial crisis, and we get nervous. But the best thing to do really is just to sit tight.
So Ethereum came along and said you can do all these different things. You can really, what he introduced was programmable money. It's decentralized, but it's also not very fast and has some still costs associated with performing on it. Then people try to lower those costs by building things on top of Ethereum. Our founder watched all of this develop. And as I said, he invented some very important cryptographic proofs. He never had the idea to attach money to them, but he watched this and he said, I think I could probably build a good one of those. Like, I know how to build this. And so he came along and he built Algorand. And Algorand takes the best security principles from Bitcoin and the best programmability from Ethereum, and we have a very performant blockchain, I would say, in those regards.
That's a great answer. Thank you. This is another question from a business owner. This is Adam from New York City. Barely anyone I know is signing a commercial real estate lease. What do you see for this market in the coming years as pre-COVID leases expire? And I can say this from the restaurant business because I own a restaurant in New York City with a few friends. The foot traffic at our restaurant is down 35%. And so the question, Staci, for me is, will people return to work, or will there be this working mobility? I can say here at Skybridge, and again, I'm being very honest and vulnerable, I probably have twice the size of an office that I need. And you can see behind me, there's a few empty desks. There's some people working. If I move my head, you can see them. But the truth be told, We have a lot more work flexibility now than we did a few years ago. And I think people will downsize accordingly. I think it could have a negative impact on commercial real estate. What say you? Do you have anything to add to that?
Yeah, I mean, I will say I'm really looking forward to my ability to buy a nice apartment on Park Avenue. I mean, I might have to have a copy machine next to my kitchen, and not every room will have windows, but I really am looking forward to the repurposing of all of this office space into nice apartments for people. Look, I'm not going to comment really on the commercial real estate market, except to say that those of you listening that are in your 20s, especially, but in your 20s and 30s, go to the office if you can. I mean, you are really missing something. It's okay for me to work from home. It is not okay if you're in your 20s to have a career where you are working from home. The culture, the mentoring, the being in the information flow, this is really, really important. So if you can get in there at least 3 days a week, but if you can get in there 4 days a week, it will be very good for your career. I promise you that.
Thanks for joining us for the weekly market recap. If you need help being financially resilient, please head over to Wealthion.com and sign up for a no-obligation portfolio review with one of our investment advisors. Thanks again for watching. Until next time, be informed, stay empowered, and may your investments flourish.